Hi, you're at Real Turkey channel, and I'm Atilla Yesilada reaching out to you from Istanbul from our new studios, which is in my home. Today we're going to talk about the Turkish exchange rate, Turkish Lira, and I'm going to start with a very bold claim. This is not a traffic bait. Turkish Lira will be the king of emerging markets in 2025. We will receive oodles of carry trade money or foreign financial investment. Now, if you follow emerging markets, or Turkey in specific, you would immediately realize that I'm saying something very controversial. In terms of emerging markets, Trump's re-election has created real troubles. In terms of Turkey, Turkey has a relatively high budget deficit, and Turkey's central bank, in its last Monetary Policy Council meeting, while keeping the interest rate stable, has signaled very strongly that it will soon start cutting interest rates. In general, although not always, if a central bank cuts rates, the currency of the subject country would weaken, would lose value. Why do I think Turkish lira is going to be an exception? Why do I think in a year where not a majority but a substantial minority of major investment banks believe is going to be a bad year for emerging markets, I expect Turkey to draw a lot of financial investment? Our story starts in the United States. Trump's re-election has completely reshuffled the deck and the game that's being played. Essentially, Trump promises to impose 10% tariffs on all imports, 60% on China. He immediately proved that he is serious by announcing officially that all goods and services imported from Canada and Mexico will be subject to a tariff of 25%. Now, these tariffs have domestic effects, one of which is that they are inflationary. If imported goods are becoming more expensive, companies will have to reflect that to their final prices. If they are inflationary, then Fed can't cut interest rates simply because American inflation, as measured by core PCP, Fed's favorite indicator, is still above the target of 2%. Also, American economy is growing too rapidly for comfort and could produce more inflation. So, Fed rate cuts are good for emerging markets, but if Fed, as I expect, is going to postpone its rate cuts or slow the pace of monetary loosening, that's bad news for emerging markets. There is another bad news for emerging markets, which is American budget deficits. American budget deficits in this fiscal year is probably 6% of GDP. According to independent observers, until under Trump's policies, this could rise to 8% of GDP. To put it differently, the policies promised by Trump during his election campaign could add 2.5% to state debt, to federal debt each year. This would push American bond yields higher. And since everybody in the world borrows on the base interest rate of American 2-year and 10-year bonds, their borrowing costs will go up. Some will declare insolvency, others default. So in general, assuming Trump delivers on his promises, it's going to be a very bad year for emerging markets. I could also add that I'm really not convinced that China's support measures would really rejuvenate its domestic demand, but that's a different question. And now let's go to Turkey. Turkey, if, as the majority expects, is going to be a bad year for EM, is going to be one of the worst victims, simply because we have a very high inflation, currently 44%. The central bank says that it will cut inflation to 21% at the end of 2025, which no one believes. Not even central bank, to be perfectly honest with you. And usually, a country's currency depreciates in parallel to its inflation, assuming that the currency is in a free float. That's its value is determined in the market. This is where my controversial call comes in. Turkey is not a free float country. Turkey is a dirty float or crawling peg country, which means while the value of the Turkish lira is not fixed against the dollar, as the case is in, for instance, Hong Kong and Saudi Arabia, the rate of depreciation has not much to do with inflation. It's the central bank which decides how much Turkish lira ought to depreciate versus the dollar. If central banks target CPI inflation at the end of 2025 is 21%, then to achieve those targets, the lira must depreciate much less than 21% so that the price of imported goods go down in Turkish lira. I think dollar TL will appreciate only 15% in 2025. Now you may say, 15%? Jesus Christ, that's a lot. Why would anyone buy Turkish lira assets when they lose? They're going to lose 15% in dollar terms. There comes the big reveal. Simply because Turkey's rates, be it the repo rate, the overnight rate, the 2-year bond rate, 10-year bond rate, Turkish lira deposit rates, are all going to yield much more than 15%. For instance, right now, the Turkish 10-year bond yields about 25%. Do you see the story here? On one hand, imagine you are a fund manager on Wall Street. You are trying to decide where to allocate your money. Here is Turkey. Dollar is going to appreciate 15%, which is your potential loss. But you can buy an asset that guarantees 25% return in Turkish lira or 10% return in dollar terms. This is called the carry trade. Now, of course, the big question is, central banks try to control the exchange rate, but sometimes they don't have enough weapons to do so. What is the weapon? A country's FX reserves. There, Turkey is extremely lucky. Turkish central bank now has gross FX reserves of $160 billion. The entire amount of foreign investment in the country is believed to be around $30 billion. So in a bad case scenario, let's say a war, God forbid, another earthquake or a political crisis, all the foreigners decided to pull their money out of Turkey. Central bank would pay the $30 billion and you would still have $130 billion of reserves, comfortable enough to manage the currency as it wants to. A second question you may ask is, well, your inflation is 40%. The dollar TL appreciation rate is 15%, which means everybody will import goods from abroad simply because all the imported goods have become cheaper, which is true. Certainly, a very strong lira is bad for Turkey's external deficits. But there, once again, Turkey is lucky. For one thing, currently our current account deficit is roughly 1.5% of GDP, and that's considered very small in terms of the emerging markets. Turkey can easily borrow even at higher rates to replenish the reserves lost to current account deficits. Two, today really is a special day for me because at 4 a.m. this morning, a peace deal between Hezbollah in Lebanon and Israel went into effect. I hope the bloodshed ends, but above and beyond humanitarian concerns, that peace, if it holds, if it can be enforced, is going to reduce the risk premium on energy and potentially lead to a decline in Brent prices. Most of Turkey's current account deficit is energy imports. If the Brent price declines by 10%, Turkish current account deficit goes down by 3.5 billion. So we can get lucky there too. At the end, there is only one scenario which would deter foreign investors under this picture from investing into Turkey. A run on foreign currency deposits by the locals, because locals hold roughly $200 billion of FX in their deposit accounts, in their savings accounts. Is that feasible? No, it's not. As I've said, there are black swan scenarios. Remember the earthquake last February? God forbid, assume it happens in Istanbul, which is really not a far-fetched scenario. Istanbul sits on a very active fault line. Or there is another war, say in Iraq, or between Iran and Israel and the United States. Or there is a political crisis. One of our political leaders meets his ancestors because they are very old. Now, in those scenarios, it's reasonable to assume, yes, Turkish savers will run to the banks, withdraw their dollar deposits, and since the amount of these FX deposits is much higher than central banks' reserves, Turkish lira will crash. But come on, if you're a fund manager, you take risks like that. Otherwise, you would not be investing into emerging markets. Obviously, I've talked about Turkish lira, but if investors favor Turkish lira, Turkish stocks and bonds will go up in prices as well. Real estate, you are wondering, wait till my next video because I have another surprising revelation for you concerning Turkish real estate market. This has been another broadcast of Real Turkey channel in cooperation with Mesele Ekonomi, the premium economics channel of Turkey. I want to express my gratitude to their production team, and I hope you like this and subscribe or share it with others who might be interested in Turkey. In any case, happy Thanksgiving to everyone.